always think of this visually. And if you go on the UniV3 white paper, this is the X time Y equals K formula. And the slope, if you have token Y and token X, they are put into the smart contract at different ratios. If you put a lot more of token Y than X, the slope is higher, so the price of X is going to be higher. If it's all the way down there, the price of Y is going to be higher. So it's a very easy system to implement. I guess Vitalik talked about this like in 2015 or 14. And out of that, you have the UniV2, sushi swaps, all the alternative layer ones, AMMs, are based on that formula. You have two tokens in a pool. You get some of X out. You have to put some Y that moves you along that curve. And that makes the pricing kind of respond to the market forces very, very in a very straightforward manner. Now, if you go and do this with Uniswap v3, you still have the same X times Y is equal K function, but you can specify a certain limit as to where your liquidity is going to be deployed. So effectively what this does is that it's translating that curve so that at B, you are 100% token X, token Y. At point A, you're 100% token X. But in the middle, as an LP, as long as you're in this region, you also have the same X and Y is equals K, where the ratio of your assets and the slope at which it sits gives you the price. So this is really a common way of thinking about options. Not options, but AMMs. Two assets, market-driven buys and sells makes the price moves, and it has to sit on that curve here. But if you look at the value of your tokens, you start with some ETH, you start with some USDC, you put them at 50-50 ratio. And as the price moves, you get a little bit more ETH, perhaps, you get a little bit more USDC, so that the ratio changes. So what you can do is that you can change this formula into something that looks like the value of your position as a function of the underlying price. So these two ranges here, lower tick and upper tick, would be your point A and point B. So now it's not following the curve here. If you're below A, you're 100% ETH, for instance. So if the price of ETH goes down, you go down with it. So you're not transforming anymore. You're fully committed to being ETH below the tick. If it's above, it's 100% stablecoin. You're fully committed to be stablecoin, so it's stable. So that's just coming in. I try to play with the equations a little bit, change that X times Y is equals K expression into something that looks like this. And again, naturally, you see that this shape, which tops off at high prices and has one-to-one directional exposure at low prices, kind of looks like, as I mentioned, a type of option called a covered call. Covered call or a short put, those are two options that you sell. So if you go on your TD Ameritrade or Fidelity account, you may be able to trade options. If you were to sell a covered call, you would generate, again, this type of payoff where below your strike price, this is something you define. You have one-to-one exposure to the asset. Above, it stabilizes and there's a plateau. And the amount of premium, or you sell something, so you get paid, is going to be how high this line is. So here in the world of options, you get paid, and this is how high your line is. In the world of UniV3, the height of this is the amount of fee you collect. So you start collecting 0 fees, so you're already on there. As you collect more fees and your position is in range, then it goes up and up and up. So there's a very natural way of linking what you see in the options world, which is this kind of truncated payoff on the high end, and a UniV3 LP position, which is also stabilized over high prices. So that's kind of the starting point if you want, and you can go deeper and deeper. I've published a white paper. We're working on the protocol itself, but only because of this very simple observation. This figure here looks like this. Why don't we create an options protocol on top of Uniswap v3 now, where you trade the LP tokens in a way that you could trade calls or puts, the same way you do it in TradFi. And that from there, that's kind of the result of many months of research. You can effectively create an options protocol on top of any asset that's tradable on Uniswap v3. And that's kind of the key point of, again, Panoptic, which is this protocol that I'm using, but also me, myself, I'm a huge LPer. I have hundreds of positions that I've minted over the last year and a half. And I approach this not in terms of staying in range, not in terms of impermanent loss, but rather in terms of how can I manage my position the same way I would manage a covered call or a short put or any other position that I'm creating in a TradFi world. So that's kind of the key basic observation behind how I myself am able to be a better LP, if you want. I was writing my blogs that people can also share it and use perhaps the same strategies. But at the end of the day, if you want to be successful, if you want to be in a region where you understand the risks a bit better than just impermanent loss is bad, you can actually shift your mind out of LPing and use this as a options selling strategy. Even though you're not selling something to someone, the payoff, the risks, the convexity, I guess, of your payoff is like selling an option. And yes.
Yeah, sorry, real quick. Just to let you know, we have a Slido going on. I'm not sure if you can see it, but there's a series of questions. Do you prefer we save them till the end, or would you like us to?
Oh, actually, no, yeah, that's fine. I didn't see it, so it's the link is posted, right?
Yeah.
Yes. Exactly. More than happy. So I can.
Yeah, I don't want to just.
No, that's fine. So that would be the best point to answer questions, because this is now, even tomorrow, you can, if you've been LPing, you can shift your strategy a little bit. If you haven't been able to be successful in UniV3, you can change your mind a little bit and look at it in terms of selling options. But yes, so that's kind of the current state. If you want to LP, think of it as options, and then maybe the questions will be yes, what people are asking. So there was one question about V3, Uniswap V3, because of this concentrated liquidity, is more efficient, a lot more capital efficient than Uniswap V2. It's hundreds of times more capital efficient. You can think of UniV2 as providing liquidity between minus infinity, 0 and plus infinity, whereas in Uniswap V3, as soon as you shrink your bound, you go from infinite range to 1%, 10%, even 100% change. It's a lot more capital efficient than on Uniswap V2. So I think that is what I think is the end state of a lot of these AMMs, is that concentrated liquidity generates a capital efficiency that you see again in the world of options. And if you were to bring in some quant finance people and say LP in UniV2, they won't touch it because of the capital inefficiencies, but rather if you do it with this concentrated liquidity, and also I'll talk about that, but in Panoptic as well, we add an extra layer of liquidity capital efficiency. That's also kind of how you can now get paid or get fees that match the risks that you're taking. So the V4, I don't think, or the next iteration will not move away from concentrated liquidity, in my opinion, because this is kind of the end state I want to get at. But it's mostly going to be perhaps smart contract implementations, maybe cross pools or something that is a little bit more iterative on this idea than just something. Maybe someone else would come up with a totally different design, but at least for me, it's kind of the more useful one.
I think along this note, one of these questions is kind of mentioning the AVAX version, which is tick-based, right? It's far more binarily tick-based. Yeah, do you have any thoughts on all that and like how that actually impacts things, I suppose?
You mean the Trader Joe's concentrated liquidity?
I think so. Whichever one it is, there where instead of having curves in between the ticks, they just have these binary ticks.
Yeah. So I think that's fine. It's good to have diversity.
Is it better?
Again, so I don't think it's better, and I think it's good that they diversify, but the fact that there's a discontinuity between one tick to the left or to the right, and as you say, it's a constant price, and then there could be a tiny movement, and there's a huge payoff. So traders will be kind of seeking these like very, very sharp points that make your trade be a bit better than the next, and you try to. So but that's the other side. So the key point is that this is x times y equals k. You could have a different continuous perhaps curve. Doesn't have to be that. Could be something that doesn't work at full scale but works within a 1% range, and that could be maybe sharper, shallower. Even they use a line here, which is again this continuity. You could have something that has a little bit more convexity. But yes, I mean it's fine. Maybe they'll see that it works, and I'm wrong. Maybe it's also going to be a problem they have to readjust. But overall, I'm happy that they are thinking of the same type of approach. And then maybe again, it's going to be a more a better solution as well than UniV3. But yes, so that's kind of my opinion. So there's another question.
Well, it's
so
good to see experimentation, right? Just like at least someone's not just cloning, right?
And overall, it's just they have tons of volume. The team, I'm sure, is well funded. Whether they do it in one way or the other way, they have the funds or the resources to shift and adjust. And if they see a fundamental flaw, or if it works much better, then they can latch onto it. So I wouldn't fault them. And I think that's, again, they do have advantages that could make it worthwhile.
So I think the more generic thing to get into is about how you actually start to price these things. Because there seems like there's a few questions around like perpetual options, how you price them with Black-Scholes, options payouts, right? Like, I guess so yeah, how do you really look? Does Black-Scholes matter? That's like number one, probably, right?
Exactly. So as I mentioned here, when you trade an option in your TD Ameritrade account, you get paid. And the amount that you get paid is dictated by the market. You have market makers that know everything about the S&P 500 to the long tail of assets of stocks. They know everything, and they know how to price pretty much any underlying asset. So if you sell a call on Tesla stock, or you sell it on IBM, one of them may be more volatile than the other, but both of them will give you a price which is kind of market driven and fairly just if you want. So you have to trust the quants, the high frequency trader, the Citadels of the world, perhaps. I don't know if we want to trust them, but they would generate a price for you and quote a price that, again, you can haggle, but it's actually very, very accurate because it uses Black-Scholes, some models that have been tested that everybody somewhat agrees on, so that buyer is happy with the price they get and the seller as well. So in TradFi, you don't have to worry about it as a user. But if you look at it in Uniswap V3, as I mentioned, the fee that you collect, this will be your premium. And if you do this, one of my posts tried to derive what the average revenue would be as a function of the width of your position and the volatility of the asset. And there's a few things that have to come in. So it's a very intricate calculation. But at the end of the day, you can also say, okay, if the fees that I'm collected is the premium of an option, and this fees is X, if this were an option, X premium over a certain number of days would correspond to a real price. The only parameter you have to fit is the implied volatility of that instrument. So the implied volatility is what the market prices, say, an instrument at. The realized volatility is the real historical movement of the price, again, over the past day or year or week. So if you start from this basic assumption that LP revenue is premium, then you can extract one single trading parameter, which is the IV. And this IV is actually easy to compute. You can see it from the on-chain data. You have the liquidity, the volume, the fee tier. There's a few quantities that have to come up and again, come together in the right way. But you can actually compute this. And now that's why I'm shifting. So I did receive a grant from the Uniswap Foundation to, again, support these ideas to kind of do the outreach of how LPing is like options. And part of that has also allowed me to fork the Uniswap analytics interface. So this is the Yubo, my Yubo website, different color scheme, but it's the same one, but it's the same basic interface. But what you can do now is, oh my God, there's a lot of, you can go on each pool and find what is this implied volatility. Again, it's a volatility that's not necessarily the realized on the price movement, but rather a market-driven volatility. So now, if I'm sorting this with TDL, forget about these shit coins, but ETH USDC are two pools that have a lot of TDL, and they have a lot of daily volume, and the implied volatility that you can compute from that is, again, 74% for the 0.3%, the 30 basis point, 81% for the 5 basis point. So if you come in with this framework that, and let me just keep this each stablecoin pairs. If you come with this idea that each pool has an implied volatility, the returns you get will be proportional to that implied volatility because you kind of fit this with the Black-Scholes model. Then you can see the different IVs. Here you have ETH-USDC, ETH-USDT, DAI, all the different pools. In theory, they should all be the same instrument. ETH on the Coinbase exchange or ETH in Uniswap v3 should have the same characteristics. They should have the same volatility. They should be priced the same way. But what we see is that there are tiny discrepancies between the different pools. So for instance, the 30 basis point has a slightly lower IV than the 5 basis point. And if we were to look, and maybe I'll look, so that what that means is that if you come in, you have ETH and USDC and you're ready to LP, the one that has the higher IV would generate more revenue. So if you were to make a choice between the 5 basis point, the 30 basis point, or even the 100 basis point, currently it's exactly the 100 basis point, but if we, or the 100 basis point will have a higher IV, higher revenue, and at the end of the day, you should get more return. And so that's kind of what I use myself on the ILP. I look at the liquidity distribution of different pools here at the current tick, and that's also why it might be skewed. Some smart LP put all of their funds in a tick-wide position at the current price. So there's a lot of liquidity now. If it were to move 0.3% to the left or to the right, all of this liquidity is out of range, but they've collected a large fraction of the fees in that range here. So that's why perhaps this one has a slightly lower IV, because you're going to share the revenue with this concentrated LPer. If we were to look at the same distribution on the 30 basis point or the 5 basis point, I'm sure we won't get that high liquidity. Yes, Gabriel, I think, has a question.
Yes, thank you, Guillaume. Still on this topic that you are raising, so being as concentrated as possible, one of the questions that I also had beforehand was the topic of active liquidity management, that you can employ different strategies, for instance, trying to predict the range using machine learning or things of that nature. I was curious to hear your thoughts on this.
Yeah, sure. So this very, very narrow liquidity is actually hard to manage. Turns out that the width of your position gives you a time scale as to how long you'll be in that range. So if it's a 30 basis point wide position, single tick, on average, it's going to move out in a day, a few hours perhaps, but very quickly you'll be out of range, you'll have to readjust. If you widen your position 1%, 10%, 50% wide, if we were to go on that whole range here, you're pretty confident you'll be in range for the next week, even perhaps the next month. So there's a trade-off between the width of your position and the time scale of how frequently you have to manage it. So again, there's a if you start from this, Black-Scholes is giving you the options premium. The width of your position gives you a payoff. You can extract now a time scale to your positions. And if it's a very wide one, it could correspond to, again, a 30-day type of readjustment. If it's very tiny, it could be less than a day. And I don't have it here, but I do have a fork of the Uniswap interface as well. And it's, I need to connect my wallet, perhaps. Am I here? Yeah, anyways, you can go to app.ubo.org. If you were to create a position, it's also going to tell you how wide or what's the time scale of your position. So again, long story short, if it's a tick wide position, it's like an option that's 15 minutes from expiring. So 3:45 p.m. on a Friday, everybody's scrambling. You have to close or manage your positions. Gamma or pin risk, if you know letting go, is very, very dangerous. So these guys here will probably have to manage it in a very, very, very active manner, because within 2 hours, pretty much certain is going to be out of range. If it's 5%, it's about once a day that you have to readjust. If it's 20%, it's about once a week. If it's 40%, it's about once a month. So that's something that the retail user can use as a guide, perhaps, so that you can't compete with the single tick position management, but you can be a bit wider. And if you do it every day, every 2 days, if it's every week, and that's what you're comfortable with, you just have to choose a range that makes sense to you. So that's also kind of one thing that is kind of emerging from that research, that the width is time in a sense, that gives you kind of a range as to how long you'll be in range for, given that time scale.
So if the option itself, or rather if a liquidity position is effectively a straddle, is there a large enough market for people that are buying like essentially strangles to hedge their position? Or like, yeah, where do you see that sort of thing going?
Yeah, exactly. So and that what you said is perhaps tainted by impermanent loss. The actual shape of your position, as I mentioned, is a covered call or a short put. You have no risk to the upside. If you were to lock your position between $1,500 and $2,000 in ETUSDC, your bean range, if the price shoots up to 2,500, 3,500, maybe 5K back to where it was a few months ago, you're happy because you've made money. You sold your ETH on the way up, but at least you've made money. So what the primitive of the LP position is a short put. And if you were to just look at UniV3, everybody's selling puts, sell, sell, sell. There's only one way for the IV to go down, is that it's going to go down because everybody sells something. With, again, Panoptic, which is kind of, now that I have this research, I got to a point where, okay, I need this actually. I need to buy puts. I want to buy calls. I want to create these strangles. How can we do this? You can't do it on UniV quite yet. This is when we came up with Panoptic, where we can actually now create multi-legged, slightly more complex strategies that now use puts, calls, long, short, the way you want. So, sorry, so I was able to log into the interface. Just to go back to Gabriel's point earlier, if you go to the Nubo website, you can create a position. Now it's 15% wide. And you can see how it looks with respect to the historical pricing, more or less. There's a effective base to expiration. So plus or minus 15% in the current conditions where the volatility is about 78% in the ETUSDC 30 basis point pair, that corresponds to a 5-day. So again, I would be comfortable with this. I'll go back in 2 or 3 days. Most of the time I'll be in range, but once it's established, this is after 5 days or more, then I need to adjust this. So I do show the payoff curve here, your short put that is created. If I were to shrink it, you see how it affects this. If it's much wider, payoff is also much wider, but you have a little bit more upside. So again, it's all a trade-off. And here, if I'm much wider, this is 18 days, which is, again, looks like a lot. But if you look at the volatility of these assets, ETH tokens, they actually are fairly volatile. 78% is at the lower end. They can be 120%. And that's kind of the idea. And then just to touch this point on, so I won't, I can show you a few positions of myself, but if you also use the interface, you can also visually see how your positions are faring in a way that's actually a little bit easier to handle, in my opinion, than the vanilla LP UniV3 LP interface. So if you've been able to use, if you've used Uniswap V3, you'll have this fancy NFT here. I can swap this for the actual payoff again. Looks like a covered call. I know where my range is. This spot price is here. Still in range. I like order finance quite a bit. I'm in that pool. I can see how I've fared over the past few days. Still in range, collected the healthy amount of fees. When I'm in the red, that means that with the fees, with the impermanent loss on the downside, I'm losing. So here I'm on the edge, but as soon as it goes up, then I'll be collecting fees and I'm happy with the whatever. 0.3 ETH, which is again sizable. So that's kind of the current experience that you have in EV3. You can use Uber if you want, but we'll use a similar type of approach in Panoptic, where riding liquidity is like selling a put, and selling a put has this type of payoff. And if it goes up, you can roll your puts up and follow the price. If it goes down, you're unlucky, you have to unwind, adjust, and then kind of be a bit more strategic in your positioning.
I
So,
think
yeah, so-
maybe some
Mhm.
background into some previous options projects. I think one interesting thing to talk about is going to be how you actually ended up designing Panoptic to make them tradable, right?
Yes.
And then as well, like I think there is a large conversation around the failures that other options protocols have had over time, right? Like I would bring up Hedgic as my perfect example, right? Although I mean I don't mean to just necessarily shit on them. Yeah, like do you have opinions? How did you end up turning this into a protocol and deciding like this was the design that needed to be implemented over others, essentially?
Yeah. And again, this is just driven by what I would like to use. I do trade in TradFi quite a bit. It's fun, again, expensive hobby to some extent, but you can create a lot of directional strategies that are way more interesting, in my opinion, than just buying GameStop calls or buying puts on the S&P 500. You can create delta neutral strategies where you know exactly what the payoff is. If it's above or below a certain range, you lose. Otherwise, if it's within that range, you win. You can also create negative delta, positive delta. There's a lot of strategies that go with options that a retail trader like myself, or a market maker, or anybody that trades options knows about these kind of multi-legged strategies. Here, this is 2 legs. This is 3 legs. This is a single leg. But if you look at existing options protocol, they kind of lacked this composability, both between different legs, but also between long and short options. So here, this is a short put and a short call that creates your strangle or your kind of delta neutral strategy. Here, this is this is 2 short puts and 1 long put. So you can create long and short puts and calls, and you can create pretty much any payoff you want. And that's what I was seeking. And that's even with Hedgic. Hedgic allows you to buy calls and buy puts. And that's basically it. You can sell to some extent, but it's not as directional. What you want to be able to do is to sell exactly the payoff you want. And in TradFi, the market maker is going to be the one buying the option on the other side. And we realized this was probably a problem, that if we wanted to implement a market or an exchange between parties on the blockchain, we would run into the same limitations that, say, Ether Delta or DDEX or any order book protocol that tried to implement swaps before Uniswaps came in. You can't really do peer-to-peer exchange, or if it's peer-to-peer protocol, you cannot have something that has to be managed kind of in a closed manner. So that's kind of the 2 motivations: the composability between short puts, short calls, long puts, long calls, and also not having to interact with someone else. And that made us kind of revisit what is an option. The UniV3 primitives seem pretty good, and that allowed us to do short puts and long puts. And the key point is that if providing liquidity is setting a put, borrowing and shorting an LP token is going to invert the payoff from a short put to a short call. So the same way you short an asset goes from there to there, you swap with the y-axis, you can do the same thing with the payoff of a put. So just by slowly going through the motion, if you want, going through the math, we're able to create all of the different positions that now can be combined. They can be also sold through the protocol, in the sense where you provide liquidity. Liquidity goes into Uniswap, and the fees you collect is the real fees that are kind of generated by the trading activity. And again, oh yeah, this is all the different strategies I'm dying to try out. Both in Panoptic, I have positions like this in my own portfolio. They all have fancy names: Jade Lizard, Spike Lizard, Zebra, Iron Condors. You may have heard some of them, but they are kind of a versatile tool. It's like a toolbox. It's always fun. Okay, do I do an Iron Condor or a Strangle? They each have different advantages. One of them is defined risk. You can only lose so much. Some of them are undefined, where you can lose all of it, even more. So it's just having more tools and going a bit more strictly beyond buying puts and buying calls is what I was kind of seeking and what I was looking for. So even with the mildly successful options protocol like Open and Premia, there's a few of them that seem to also go in the right direction, but the composability is actually not quite there yet. So that's why we had to kind of scratch and start from scratch, and create a real options protocol where the core primitive is UniV3. So Unity 3, you had Dan Robinson spoke earlier, but he created, and the Uniswap team created a perfect options protocol. You just didn't realize that the LP side of it is options, and the spot trading is just kind of the AMM part. So, and there was one question about, it doesn't have to rely on Uniswap v3. Is if SushiSwap or Trader Joe's on Avalanche creates this similar concentrated liquidity provisioning, then we can build a similar protocol. We could even have a pool of funds that will be routed to the right AMM, whether it's Uniswap, SushiSwap, or whatever. But yes, it has to be concentrated. But once this is done, there's enough liquidity. The same fancy looking payoff can be created in all of them.
So is the goal to largely be composable and have stuff built on top of you guys afterwards?
Yes, exactly. So the first idea is that we benefit from Uniswap v3's openness, and we connect into their smart contracts directly to create these options. And again, adding liquidity creates this type of payoff. But here it's a user that puts liquidity here. You could have Arrakis Finance now or Gamma Strategies. You can have vaults built on top of a strategy that is not just adding liquidity, but perhaps buying liquidity as well, buying an option, having a delta neutral strategy, all of those fancy. You could have a spike lizard vault that is just 4 options that need to be tracked, a manager that can do this for you, and people would deposit the funds there. So that's what we won't be necessarily building those, but we would enable this for other protocols to do, as you mentioned. And yeah, so again, we actually are done with the code. We're preparing for the audit. We're in stealth mode. We have actually closed our round, and this week or next week we'll be kind of announcing the results. But yes, I'm excited about the protocol itself, but also how people can build on this.
So what actually are Panoptic positions? Are they a 1155? Or are they an NFT? Or yeah, what actually is it, and how do you actually trade them, right?
Yeah, so when you look into Uniswap v3, this is something you can do now on the UBO or the interface. They issue to you an NFT, which is a 721 NFT. And that's because each position is unique. You put it to a range that's defined by you. The amount of liquidity you put is also defined by you. The pools, the feature, everything is so unique that you have to have a non-fungible token that tracks this. So what we do in Panoptic is that we kind of bypass to some extent the NFT smart contract that Uniswap has developed and kind of deployed. And we created a semi-fungible position manager, meaning that we use the 1155 standard to track positions. And the key point is that a tick-wide liquidity is unique, but then many people can have the same position. They can come in and mint a tick wide at the current price, like the person we saw earlier, but you have a semi fungibility. Each position is unique, but a lot of people can participate into the same position. So is 1155 allows you to. Sorry, I didn't mean to interrupt. Yeah. So just quickly, the 1155 allows you to create a balance as well. So the token itself is a non-fungible token, but you can have a balance. NFT 71 is just one. Now you have a balance that corresponds to your liquidity or your share of all the liquidity.
So is the goal there to essentially create secondary markets, right, where everybody is using the same maturities, and as well, do you allow people to choose arbitrary maturities, kind of? Yeah. How do you think about liquidity?
So that's why you had to maybe unlearn a few things about options and what you know about options. So we had to do away with expiries. If you go on your TD Ameritrade account, you want to buy a GameStop call, it's the one that expired 5 days in the future, $1,000 strike. You had to pay whatever $200 to buy your call, and if by any chance the squeeze happened, you would be in the money, make a lot of funds. But if at 4:01 or 1 minute after expiry, you're not above your strike, you lose your funds. So that's kind of the current way. You have to roll, you have to redeploy, you have to have a timeline. And if you don't do anything, sometimes it expires worthless, sometimes it expires in the money and you make money. But there's an extra layer. So each time step fragments liquidity in a sense. So because we're using Uniswap, because we're using these liquidity positions, we can say these options are perpetual. They don't expire. You can hold them for 10 years if you want. And the amount of premium you pay as an options buyer or the amount of premium you receive or collect as a seller will be the fees that are generated by how frequently price touches that strike. So if you want to hold it for one block, you can actually have an option that costs you 0. So if the price never touched your position, you deployed it, burn it 1 block later, costs you nothing except for the gas fee. If you hold it for 10 years, then as a seller, you can collect a lot of fees, or as a buyer, you can also collect a large amount of fees as well. So the fees accumulate over time. So that's also kind of a new way of thinking about that.
So how do you is it more like a borrowing agreement between the two parties?
No, so and also the key point is that it's not a peer-to-peer type of interaction, it's a peer-to protocol. So whenever we say,
is it still feeling like borrowing? How about that then? Yeah.
Yeah. So here the borrowing, you buy a put, someone put some liquidity at strike K, you came in. I put some liquidity, I'm a seller, you came in and bought this. So they remove this block of liquidity. And the key point is that you have to enforce paying it back. Like any lending protocols, you can buy a car, you can go do something else. Here, paying back was the issue. So the way we solve this is that the funds don't leave the Panoptic Uniswap ecosystem. So the funds that you borrow don't go to the user, they go somewhere else in a different smart contract in safekeeping if you want. And the user has control of them. But at the end of the day, if you have to pay it back, you don't have to look through the wallet of the user, you just have to look at the smart contract balance. So that means someone that sells an option, sells it, and they collect fees. Someone that buys an option, when they buy it, they don't pay the seller, they pay the protocol or the vault that held these funds into kind of safekeeping. That means that the whole protocol works, even it works better if there are no buyers at all. If there's only selling, and nobody gets paid because of the trading activity that happens with Uniswap. And that's kind of an enhanced LPing experience if you want. So selling is like an enhanced LPer. BGins that want to buy options, they can now buy it. It's a bit extractive to the protocol. They remove liquidity away from the Uniswap pool. It will increase the volatility. But what happens when the volatility increases? The price of the options increases as well. So if there's too much buying, the price will go up. Everybody will have to pay a bit more. The sellers will be happy to get paid more, but the buyers, the GameStop call you bought at 1,000% IV, you can also buy a Shiba Inu perhaps put that will be priced quite high according to the IV of what the market is dictating.
Cool. So all right, let's get into more of these questions, and this is kind of related-ish. In a question as far as, have you looked at any existing perpetual option protocols that exist? And I think you'd essentially said that the main differentiator sounds like composability at the end of the day. But yeah, like I guess what else? What do you really feel about them? What do you feel about their pricing models? And like the goal for today is to talk about market design. So if you've got any more specific things on that too.
Exactly. So I think like Lara Finance actually is a kind of successful product. They are on optimism. And then they have good enough trading activity. And the key point is that yes, if you want to buy an option, you can go there. Everything is seamless. But I would say that yes, the composability or perhaps the permission nature of some of these instruments make them maybe harder to scale. In TradFi, you have this Chicago Board of Auction Exchange or the Mercantile Exchange CME that dictates what the strikes are, which assets gets listed, like the Macro Ether futures got listed on the options with an option change a few months ago. So it's still permission to some extent. And I would say that that means that the protocol itself has to guide, okay, this is going to be the strikes we're going to have. If the price goes to 5K tomorrow, all the strikes have to be redeployed or re-implemented in the protocol. And that makes it so that, again, it's easy to do in TradFi, but if you do it in the blockchain world where the markets, again, are less fluid and liquidity has to be moved, that means that you kind of have some roadblocks, especially after large moves, or if a new asset is listed, or if kind of an existing asset has a kind of a liquidity drain or too much liquidity. And again, I would say that the differentiator between us or any successful DeFi protocols should aim to embrace the limitations of DeFi instead of fighting them. So layer 2s allow you to cheat a little bit and be a bit more complex in your calculations without worrying about the gas too much. But you're still going to hit a different wall somewhere else. But if we, again, what we decided to do is start from scratch, start from this very simple primitive that's an LP position, and now build something that doesn't look quite like an option. But again, it's priced in a way that's organic. It's also, you can permissionlessly deploy them. So at the end of the day, it's just a trade. Again, I would say that Uniswap was a 0-to-1 innovation in how we swap between token A and token B. So we hope we can achieve something similar with the other options as well.
Cool. I guess so this is more of a generic one, and you kind of mentioned it, but you've been doing research obviously on this stuff for a long time. Honestly, I thought that you guys had already closed your rounds, but you know, how did you end up turning it from research into like, you know, a real project, right?
Yeah. And again, having a cushy tenure track position in applied physics at Cornell, Ivy League school, my dream job more or less. And again, the excitement that I see in Panoptic and DeFi is enough to drive me away, unfortunately, from my academic job. But yes, so I feel like this is kind of new frontier. At the end of the day, science in a way progresses, but it progresses slow. There's huge spikes of advances. But at the end of the day, it's a very, very grinding thing. So now I felt like there was a unique opportunity in the world of DeFi, especially in options, that I could contribute something unique. Again, the summer product that was my research evolved into something that seemed like it could be a product. So the next step was, yeah, why not making it? So I was able to get connected with folks at Advanced Blockchain, which is an incubator company. I got in touch with my what is now my co-founder, Jasper Christensen. So we are both kind of spinning off of Advanced Blockchain, doing a race, but at the end of the day, we want to create this awesome new product, which again is creating options on chain in a way that's kind of unique. And again, I would say that a lot of maybe other people would have found the same insights. If the LP token, I guess it's nothing unique, everybody could see the payoff. Now it's just kind of how can we make it the best possible product. And again, with these slides, we go through, there's quite a few obstacles we had to kind of route around, but at the end of the day, we will create something that is very, very, I guess, unique. And hopefully, if you want to buy options, you can do it there. If you want to LP and enhance your experience, can also be kind of a better LP because you can buy options, sell options, you can do many different strategies. So at the end of the day, the raise is just to allow us to launch. No, it's just me and my co-founder Jasper. I'm doing most of the coding now. I'm not a coder, so the audits will be what they are. But at the end of the day, we are kind of in a unique position. I think both of us kind of move to this full time so that we can actually make it where it should be. A DeFi native option for everyone.
One question that somebody asked, and then it might be good to just move to AMMs in general, is what are the particular attack vectors with doing something like this model? So
again, we are thinking about all of these things. There's one key advantage, I'd say, to the way that we're doing this. The first one that we mentioned is that funds never leave the ecosystem. Julian cannot go in and sell the collateral to buy a car. It's all within the ecosystem. So liquidations are very easy to handle because funds are there. You just have to move them back to where they belong. So someone could not pay for their put, you can just move it back, seize their collateral, everybody is made whole. So liquidations or manipulations on the actual health of the protocol, there's no oracle as well. So if you want to manipulate the price, you have to manipulate the price of the Uniswap pool. And not only that, you have to manipulate the price and be the one that buys at this low price. So again, the first advantage is that funds never leave the ecosystem. Liquidations are easy to handle. The second vector of attack is oracle-based attack, where again, in many protocols, you can manipulate the feed in one contract. You can do shenanigans in the lending protocol or whatever you want in a different contract. And the actions of this attack doesn't impact the feed or the oracle feed. It's two separate contracts. Here in Panoptic, you can manipulate the price. All of your options can be in the money, meaning that you can make a lot of money because the payoff goes the right way. But the only way you can benefit is that if the price of ETH is now $10, you have to buy it at $10 to be able to profit. So you have $1,000 put, you manipulate the price to 10, you have to buy it at 10, sell at 1,000. In theory, you make $990 of profit. But you have to remember, you're the one that sold all of this ETH to bring the price down. So you sell it, buy your own bags, do some profit here, but at the end of the day, you have to also pay back your flash loan, perhaps. So the attacks are a lot harder to pull off because it's a physical priced oracle. You can only benefit if you buy at that price. And I would say that it's the same way that some Uniswap pools can have manipulations. The thinly liquid pools may have their price go to zero. You can buy it at zero if you want. And that's not necessarily an attack, it's just kind of a way that the market works. In our case, the same thing could happen. If you manipulate the price, you can only benefit to the extent of you dump the token, you have to buy it back to be profitable.
Yep, that all makes sense. And kind of similarly, going to AMMs, how can we make AMMs even more efficient? You mentioned ERC 1155. I know that was a proposal that you did some time back. And then what you just talked about, like how to affect the TWAP, right? Like there have been some discussions on, especially moving to proof of stake ETH, that it can be a little bit more, like there's a little bit more of an attack vector there. So like, what are the things that we can do to just make it more secure?
Yeah, and I think the in the AMM space, if you're swapping, what you care is to get the best price. If you're an LP, it's a different ballgame. It's your own capital that you can lose. But if it's just swapping, if the instantaneous price is maybe sandwiched or not the right one, it's unfortunate, but you cannot lose more necessarily than the size of the trade. And I can see that in the future, the same way that the Robinhoods of the world changed the game a little bit and made commission-free trading the norm, we may see that now the 5 basis point or even the 1 basis point in Uniswap v3 becomes the pool of choice, because the revenue generated by even the 1 basis point pool could be enough if it's selling options, there's enough volumes that the amount of revenue you generate as an LP justifies the fact that you go to the 1 basis point as opposed to the 5, 30, or even 100. So from the user point of view that just wants the swaps, I say that in the future we'll see pools with lower fee tiers, competition perhaps between different AMMs, and maybe some MEV like sandwich attack protections. But at the end of the day, you get to a point where it's going to be very easy to swap the same way it's very easy to buy a stock now because of the market. The market is pushing the cost of swapping or buying stocks down because they need revenue in futures, options, and these kind of external instruments. And this is why I think the future of AMMs will go. You don't have, if it's sustainable to have a 1 basis point swaps, people will go there. You don't have to have the 100 basis point to be profitable. So this is where I think it's going. Yes.
Quick comment there. Like, what do you think about the AMMs that are doing like variant fee setups, like Balancer? Right?
So this was one of the crazier posts I made, but if you start from this assumption that the fees react to the market conditions, and the natural maybe instinct is to say, oh, if there's a lot of trading activity, then we'll increase the fees. And this increase in fees will increase the revenue, stabilize the price to some extent. And that's kind of one way of approaching it. I propose a different way. And it's just based on the math of how AMMs work in the concentrated liquidity space and the fees and the IV. But my proposal is different. The more activity there is, the lower the fees. You want to incite trading activity. If the fees go down by a half, but you have 5 times more trading, then more revenue to the LPs, less fees for the users. Everybody is a win-win situation. So this one is a weird, but I would say that it's a mind meld, but you have to think the other way. The more activity there is, the lower it has to be, not to zero, but in a way that maximizes LP revenues. And in that sense, you can target a specific fee generation rate. So you can say, I want to generate 1% per day. That's something you can enforced in the smart contract level. And if there's no trading activity, the fees go down inside it. If you you wait too long, the fees start to go up. So it's forcing people to trade larger orders more frequently in a way that generates more revenue. So that could be, so it's a neat idea. I don't think we should say, all right, USDC will have 100% vol, Uni will have 5%, and all the other tokens will be something else. It's less market driven, but it's still kind of a nice toy experiment to say it's actually more different than what you expect. The more trading activity, the lower the fees.
Very interesting. Another question that we had was around, how do you think about all these new token models and like how they're changing the dynamics of LPing, right? You have like Tokenomics, and Curve and Balancer, active liquidity managers, which you talked about a little bit, the just-in-time liquidity. You have things like Palm that now came out that are more like focused on like the DAOs trying to manage their own volatility. Just like a lot of like even liquidity mining, right? Like there's just a lot of different things that are like kind of messing with this formula, you know? So like, how do they kind of like play a role in all of this?
Yeah, exactly. I think that we're still figuring out what's the best way to attract activity. Some people equate liquidity with like a health of the protocol. That's why you have liquidity mining and you can dump your tokens there and you get some revenue by being passive. And I think that that's come to pass to some extent because it's kind of not sustainable. You have these kind of mercenary LPs that go from one pool to the other. And same thing with the active management. Again, I think maybe if people think in terms of options, it can be a bit more profitable, but it's very difficult to understand the risks. And if the token goes down, there's so much you can do. You'll actually be losing on the way down. So that's also kind of a different strategy that maybe needs to be revisited or maybe needs to be upgraded so that it's not just maximizing for the amount of time you spend in range, but rather I have a post about delta neutral LPing. So you can borrow one of the two tokens, you supply your own USDC, you borrow some ETH, that shifts the curve a little bit, limits the risks. But at the end of the day, I think it's still pretty early. LPs, again, I narrowed down on a few good strategies. I do publish them, and people can more than welcome to try them out. But it's if you think in terms of a new way of generating revenue, it's difficult. If you think in terms of options, you have maybe a leg up and you know a few more things. But yeah, so I think if the Curve Wars, the DAI token, it's optimizing for sheer amount of liquidity, and that's one way of doing this. But yeah, and then also a small comment. Turns out that if you look at ETH, USD, ETH stablecoin, BTC stablecoin, even the stablecoin pairs, the markets in Uniswap or on AMMs, they match a centralized exchange price feed. Whatever happens in Uniswap, it's a tiny drop in the ocean of volume that's traded on Coinbase, CME futures, all of these other like large players that's gated maybe, but then institutions can participate into. So whatever happens on the centralized exchange drives the price on Uniswap. So you can imagine if the liquidity in the Uniswap USDC pool was multiplied by a factor of 10, immediately the fees will also be multiplied by a factor of 10 because you have to match this volatility that happens in centralized exchange. If the price decides to go to 1200 tomorrow, it's not Uniswap is going to stop it. It's going to go down regardless. So if there's a larger wall of liquidity, it's just going to go past through it. So there's a pretty high ceiling into how much liquidity can be added to the large pools that have a centralized exchange counterpart to increase the revenues to a point where, again, it could be 100 times higher and still generate revenues that are large enough for everybody. At some point, Uniswap, AMMs, maybe SushiSwap will be the place where the price discovery happens. But before we get to that point, don't be discouraged as a LP. You can put in your 1/8 or 2/8 of liquidity in a pool that has a centralized exchange, and you won't be necessarily outcompeted. You'll be able to generate revenue that's That's right. That's following the size of your trade. So that's maybe what's happening with the curve wars, where you can dump a lot of stable coin in there. It's always going to be ARB. There's always going to be opportunities to get a few basis points here and there. And same thing, we don't see this as much, but it could be replicated in the ETH stablecoin pools, BTC stablecoin, BTC ETH, because they do have an external fee that is driving the market and not necessarily the Uniswap fee itself.
Does the Uniswap fee, like the potential protocol fee, change anything in your point of view?
Yeah, so that was part of the proposal to turn it on, actually.
Yeah, I actually,
because
nice.
I saw that the post and I checked it in, and I didn't want to. I'm curious, just from again academic standpoint, how it will shift liquidity provisioning, and if you have a 100%, so the fee is actually taxing or seizing funds away from the LPs. So as an LP, I'm a little bit impacted, but if you tax 100% of the fees, nobody will participate. If you tax 1%, it's fine, nobody will care. There's a happy medium that really needs to be discovered. The lowest fee tier that could be activated is 1/10 of the fee, so 10% tax on your revenue. It can go up to 25%. So that's going to shift perhaps liquidity where it's distributed. I showed earlier the ETH USDC pool, 5 basis point, 30 basis point, or 100 basis point have different IVs, but now you have to take into account perhaps the fee that is in each one of them. So it's a open problem that is, you can try to model this, but the real test is actually doing it. So my proposal was to turn it on for the ETH stablecoin sister pools. So ETH USDC, ETH DAI, and ETH USDT, they all match the centralized exchange price feed. They all have 3 fee tiers that have some amount of liquidity. So the proposal was to turn it on for the 100 basis point in ETH USDC, 5 basis point in ETH DAI, and 30 basis point in ETH USDT. So if you hold some DAI, you can have 3 pools to choose from. You can remove your pool from the fee switched on to a different one. Same thing with ETH USDC, all of those, or you can swap. I say I want to have a 5 basis point, you can go to the different pool. So this was going to be controlled, limited impact experiment that will test out, and you can see before how liquidity was distributed with these different sister pools, how it's going to be implemented. So we're in talks now with the Uniswap Foundation, because we didn't realize that what to do with the funds is actually a legal question that is slightly more complex than say, oh, we just leave it there. Just the fact that you collect could change the landscape of what Uniswap does. So we're going to resubmit, it's resubmitted for real vote by December 1st, but they also have to figure out from the Uniswap side what's the best way to handle either the funds. They can donate them, maybe that's the latest scheme ever, but if they distribute it back or they pay Hayden, it's actually, there's a few things that they have to
rebuy socks, right? Like, yeah.
The socks price, yes, there you go. Auto dump into socks pool.
I think we've run-ish out of questions, right? So like, if you were to be talking to the cohort and thinking about more fundamentally what you need to be thinking about in terms of design, right? Regardless of the actual product, what are the core like pillars that you really should be prioritizing with your product, right? You've obviously said composability, but like, yeah, I guess like emphasize some of that for us and kind of wrap us up, right? Yeah.
Yeah, exactly. So Uniswap has this, but most markets have 2 asymmetric sets of actors, and they all have their incentives and they all kind of benefit in different ways. For swapping, you have the swappers and the liquidity providers, and these 2 have to be kind of in agreement as to what's the best way forward. So I would say that in this stage of any DeFi protocol, you want to grow, you want to be able to expand and gain traction. So you have to tune perhaps your offering to both cohorts. You can't say swapping fees will be 0 because nobody's going to be LPing. You can say LP fees will be too high because nobody will be swapping. So there's a delicate balance between how you knowing your cohort, who's going to be benefiting, how, and again, since we're so early, the key point is you want to lower the barrier of entry as much as possible. That means perhaps making it easier to LP or having fees which are a little bit more attractive, even though you can run at a loss. Long term, you want to establish the best optimal protocol, and once it's done, this is how you can actually expand. If you can be 100 times larger and a tenth of the fees, you'll still be ahead, again, similar to what I discussed earlier. So I would say that the from a market perspective, lowering the barrier of entry for every participants, but also kind of patching the holes. Liquidity mining was one way to patch the holes. I'm not sure it's sustainable, but finding ways to kind of bootstrap some of the drawbacks early on so that you can now address them a bit later is also very important. And yeah, maybe know your product. Again, create a product that you want to use, that you think you're going to be the first one to use.
Yeah,
Again,
that's what I was going to
with-
say next was you started and you wanted this, right? So you're making it for you.
If I'm the only user, this is going to be the most expensive product for a single user ever created.
Maybe
But that's
now,
fine.
like it could be worth it, right? I don't know.
And that you don't try to create something that other people will use or a game that other people will play. Just create something that you want to do, you want to play, you want to be joining emails, and find a way to make it so that you will be the one participating and not necessarily respond to what's the latest trend in VE tokenomics or something else, liquidity mining, which was kind of DeFi summer. So we have the opportunity to reinvent more or less the financial world. And we see it's like none of us have our hedge fund managers. You can actually make it in a way that makes the retail user benefit at the end of the day. Long term, that's kind of, if we cement this from the beginning and you come in with the perspective that this is going to be what I'm going to be using. Again, in options, if you want to buy a trade in options on Amazon, Google, even Tesla, you had to put up 20K worth of collateral. It's not for the small player. If you can make it so that more people, 10x the user base, can actually create a much more healthy protocol than 1/10 of the users, but they are whales, for instance.
Awesome. Cool. I guess like that's kind of it on our end. Danny, did you have anything else you want to wrap up with? I would just give a call to action for everybody. If you want to participate in the Build Guild, we'll be having our first session tomorrow at 4. But yeah, Danny, I'll pass it to you.
Yeah, the same thing with the wiki, but Guillaume, that was such an awesome talk, and it's so cool to hear about like what you've built and like your journey to get there. It's really exciting stuff to see the innovation, and I'm excited to see how it only like compounds as that composability built. So thank you so much for coming.
And actually, I like this product. I like to talk about it. And moving forward as well, we'll be kind of doing these outreach events. I may be managing my own portfolio in real time to show, hey, this is what a Jade Lizard does. This is how it screwed me, or this is how I benefit. I do want to be part of the community in a sense where, I'm a professor as well, showing by example, making sure that people are getting content every day is also where we want to go with Panoptic.
Yeah, we're getting blown up. That'd be such a cool to see you like trade in public, you know, and to do that, and especially like with your level and your giga brain to see like the things that you made. And it's so funny when you talked about getting wrecked. It's like, oh, he's a genius and he's getting wrecked too. So it just goes to show we're all.
That's right. I'm probably going to be. That's right. Don't put more money than you're ready to lose, of course. And I've been wrecked more than once. And again, you remember the bad trades. You forget about a good trade, so that keeps you always on the edge.
Guillaume, I just wanted to say, well, thank you so much. This is incredibly clear. I loved it. To the extent possible, it would be wonderful to have even a scrubbed version of those slides. Just the ones that you showed were helpful. So if you're comfortable sharing that with the group, then I think
sure. So this is a talk I gave at DeFi Toronto like last month, and they are pretty up to date. And yes, I'll be more than happy to export a PDF. I don't. Oh, you don't see it. Yeah, I have. I can post the talk as well, but I do go through the protocol in more details, perhaps. But then again, this is going to be something that I'll explain, re-explain, go over it with new users, existing users. Also, I'm teaching it about options. Again, I want to make it so that you know about ETFs, you know about mutual funds. I want people to know about selling options, which is kind of this new cool way of generating yields. That's different. It's more risky, more reward, but you can actually choose the payoff you want. And that's why I love it. I never trade stocks. They're too damn expensive. Always trade options.
Awesome. Well, yeah, thanks again for coming on. We would love to have you back again. I'll invite you to the Slack. And for everybody else, you know, we'll have these breakout sessions at least for the next 15 minutes or so. So see you guys on over in the Gather Towns.
Thank you, Guillaume.
All right. Thanks very much.
Thanks
All right.
everyone for showing up.
Yep. Have a good one.
Later, guys.
Stay safe out there.
See you in the metaverse.
Yes, everybody in the metaverse. Actually, I need to run for dinner. So that was awesome. I hope everybody enjoys the breakout and enjoyed that awesome conversation. Hey, Alpha Key.
Yo, what's up?
Nice to see you again. I won't be there, but definitely join the Gather Town.
Cool.
got
Are you gonna go to is there a hangout after?
Yeah, there's like, there'll be one in Gather Town, and then I think that y'all are like trying to coordinate a study group. I'm gonna let y'all do that, like as a guild lead. I feel like, you know, let y'all play and explore as much as possible. As much as I like want to join and try to like usher.
It'll happen. And also to follow up on the Junto thing. So I messaged Martin. I thought that maybe